Welcome back to the Deep Dive Briefing. You know, if you're following the market daily, it's pretty clear we're in this period of, well, intense divergence.
Yeah, it really is striking.
You look at the price, the short-term stuff, and you see weakness, right? But then you dig a little deeper, and the long-term picture, the structure, it actually looks stronger than ever. So our dive today is really about trying to sort through that conflict.
And that divergence, it's probably the single most important thing for anyone in this space right now. We've got to separate the day-to-day market noise.
All the headlines.
Exactly, from the underlying fundamental signal that's really driving future value. So we've looked at the material, and it seems to fall into 4 buckets. Technical weakness, some institutional caution, growing geopolitical risk, and then, sort of counterintuitively, this huge wave of fundamental strengthening happening at the same time.
Right. So understanding how those push and pull against each other, that's key to navigating things without getting overwhelmed.
Absolutely. It's about seeing the whole picture.
Okay, let's start with the immediate pressure then, because, the short-term signs are definitely flashing caution. Bitcoin slipped below $110,000. And now it's really fighting to hold this this critical support zone around $109,500. That breach alone has kind of shifted the immediate outlook, hasn't it? More neutral, maybe even bearish?
Yeah, failing to hold that $112,000 stabilization zone, that was structurally pretty important. So now everything really hinges on $109,500.
And if we lose that?
Well, if we lose that decisively, you have to be ready for the bears to push harder. It really opens the door to potentially retesting those lows from the last crash down near $100,000.
Okay, so that's the downside risk. What about the upside? If we want to shake off this bearish feel and get some confidence back, what are the levels we need to reclaim?
There are 2 main hurdles we're watching. First, just getting back above $114,600 would be the initial positive sign. But the real test, the level that would actually invalidate this immediate downtrend, is that major resistance up at $117,600. Until we clear that convincingly, the market's going to stay defensive, vulnerable to more selling.
And speaking of selling, that pressure was definitely visible in the institutional flows. The settled data for the U.S. spot Bitcoin ETFs came in pretty weak for October 15th.
Yeah, a net outflow of $104.1 million wiped out the little recovery we saw the day before.
Right.
And this really confirms that institutional buying has hit pause, at least for now. Grayscale's GBTC, no surprise there, led the outflows again, minus $82.9 million. That's that ongoing capital rotation theme.
We've talked about that before.
Exactly. But the nuance here, the thing that caught people's attention, was BlackRock's IBIT. It also had a small outflow.
Okay, but hold on. The IBIT outflow was tiny compared to the total, right? Couldn't that just be like normal rebalancing from one big client or something end of week related? Are we reading too much into it?
That's a totally fair point, and it could be just that. But the significance is more about consistency. BlackRock has been the anchor, the one providing that steady bid people were counting on.
The market leader, yeah.
Right. So when they show even a small outflow, it just pokes a hole in that narrative of constant, endless accumulation. It suggests even the biggest players are maybe pausing, or maybe they're seeing some clients pull back a bit. That little pause, it just affects sentiment.
Got it. And beyond the ETFs, there was also that on-chain event that always makes people a bit twitchy. A dormant whale started moving coins.
Yeah, about 2,000 BTC, worth over $222 million.
Yeah.
Moved from a wallet that hadn't been touched in ages into, 51 new addresses.
So what does that usually mean? Or what do people think it means?
Well, that's the thing. When a big old stash like that moves, it's like seeing a shadow on the sonar. It could just be housekeeping, right? Maybe upgrading security, moving to multi-sig, splitting it up. Yeah. But because it happens when the price is already looking weak, it just ramps up the ambiguity. The perception is what matters. People think, okay, is this old holder getting ready to sell? Is a big chunk of supply about to hit the market?
Right, even if they don't sell immediately.
Exactly. That perception itself acts like a headwind. Buyers might hesitate. Sellers might get more aggressive. It increases the risk of things heading lower.
Okay, so that's the immediate stuff, price, flows, whale watching. But let's zoom out a bit. Is some of this institutional pause maybe just reflecting the bigger macro picture? The sources were pointing to a pretty serious escalation in the U.S.-China economic fight.
Oh, absolutely. That's definitely casting a shadow. We're seeing policy risk really jump.
Yep.
The U.S. Treasury Secretary, Scott Bessent, used some incredibly strong language, accusing China of trying to unleash chaos on global trade.
Wow, unleash chaos. It's not subtle.
Not subtle at all. And he specifically linked it to new export controls China put on rare earth minerals. This feels like it's moving beyond just tariffs and trade spats.
So framing it that way as trying to cause chaos, what does that actually do to markets, especially risk assets like Bitcoin?
Well, it makes a quick diplomatic fix seem pretty unlikely, doesn't it? It injects this sort of unquantifiable policy risk into everything, and that tends to trigger a global risk-off move.
Meaning investors get scared and sell risky things.
Exactly. We saw it almost immediately in the Chinese stock market, the A-shares. Money flowed out of growth sectors, the high beta stuff that swings a lot, and into safer havens like financials, utilities.
Tons of rotation.
Precisely. And when that global capital flight happens, assets like Bitcoin, which are seen as high risk, high reward, they tend to get hit too, regardless of what's happening internally in the crypto world.
It's just such a strange contradiction, though, isn't it?
Yeah.
How can we have capital fleeing ETFs in this global risk-off mood, while at the same time the actual foundations of Bitcoin seem to be getting so much stronger? Let's talk about that quantum shield thing.
Yeah, this is potentially a massive deal, a huge structural improvement. BTQ Technologies demonstrated a working quantum-resistant setup for Bitcoin. They call it Bitcoin Quantum Core.
Okay.
And the key thing is they successfully swapped out the current cryptographic signature method, which could be vulnerable down the line, with a NIST-approved standard called MLDSA.
All right. For those of us not deep into cryptography, why is that so important? What's MLDSA?
Okay, quick version. Bitcoin now uses something called elliptic curve cryptography. Super secure today, but theory suggests a powerful enough quantum computer, maybe years away, could potentially break it. This quantum threat has always been this sort of nagging long-term worry.
An existential risk, almost.
Kind of, yeah.
Yeah.
Especially for long-term holders. MLDSA, Module Lattice Digital Signature Algorithm, is one of the new standards designed specifically to resist attacks from quantum computers. It's based on different math, lattice problems that are believed to be hard even for quantum machines.
So by showing a working solution using an approved standard, they're tackling that future threat head-on.
Exactly, and this was particularly relevant for the roughly 6.65 million Bitcoin out there where the public keys are exposed, making them theoretically more vulnerable. So neutralizing this long-term risk with a practical standardized fix, that dramatically boosts Bitcoin's credibility as a durable store of value.
Especially for big institutions thinking decades ahead.
Absolutely. For institutions mandated to think about longevity, you could argue this is maybe the biggest fundamental upgrade of the year.
And that institutional story isn't just about long-term security. The derivatives market, it seems, tells a different story than the spot ETF outflows. The CME Group's Q3 report sounds pretty bullish, actually.
It really does. It shows market sophistication is just exploding. Look at the numbers. Ether futures volume on the CME up 355% compared to last year.
Wow.
And we saw futures for newer coins like Solana and XRP hit record levels of open interest, basically, the number of outstanding contracts. $2.1 billion for SOL, $1.4 billion for XRP.
So what does that tell us? If they're not just buying spot ETFs, what are they doing with these futures?
It means institutions aren't just leaving the party. They're moving beyond simple buy and hope it goes up bets.
Right, beyond just pure beta exposure.
Exactly. They're using more complex strategies, things common in traditional finance.
Like what? Give us an example.
Well, a big one is the basis trade, or cash and carry. They might buy Bitcoin on the spot market and at the same time sell a Bitcoin futures contract on the CME. They lock in the difference, the premium between the spot price and the futures price, which is often positive.
Ah, capturing the funding rate.
Precisely. It's a way to generate a relatively low-risk return that doesn't depend on the price going up or down. The fact that they can now do these relative value trades, hedging strategies, that's a huge sign of maturity. The market plumbing is getting really robust.
And that long-term conviction seems baked into corporate adoption too, right?
Yeah.
Which feels totally separate from daily trading whims. The value of Bitcoin on public company balance sheets hit $117 billion.
Yeah, over 1 million Bitcoin now held by public companies. It's a structural thing.
And the number of companies is growing too.
It jumped to 172 firms. That's up almost 39% just since Q2. Think about it. A day trader might panic sell on some geopolitical headline.
Right.
But a corporate treasurer making a Bitcoin allocation, that's usually a strategic multi-year decision. This kind of sticky demand from corporations provides a really strong counterbalance to those more volatile daily ETF flows.
Okay, shifting gears a bit to regulation. We got a warning from the G20's watchdog, the Financial Stability Board. They're worried about fragmented and inconsistent crypto rules globally.
Yeah, and that warning really hits on a key pain point for big global financial players. Smaller outfits might try to play regulatory arbitrage, set up shop wherever the rules are loosest.
Sure.
But if you're a massive bank or asset manager operating worldwide, you need consistency. This patchwork of different rules creates huge headaches, compliance costs, legal complexity. It definitely slows down widespread institutional adoption across borders. We probably won't see truly seamless global integration until we get more harmonized standards, maybe driven by groups like the FSB.
Makes sense. We also saw some very specific enforcement, like Australia cracking down on crypto ATMs. They cited something like 85% of transactions by heavy users being linked to scams. That sounds pretty bad.
It does sound alarming, yeah. But how should we interpret it? I actually think it's a net positive in the long run.
How so?
Because the focus isn't on banning crypto itself. It's on cleaning up the weak points, the bridges between crypto and fiat, like ATMs, that are being exploited for illicit stuff. By cracking down on the scam vectors, regulators are ultimately making the whole space safer and more trustworthy for regular people and institutions. They're removing a barrier to legitimacy, really.
Okay, that's a good perspective. Lastly, there was this kind of unexpected political angle that popped up involving Bitmain, the big Chinese mining gear maker,
Right.
and some preferential financing terms they apparently gave to a company called American Bitcoin, which is partly owned by Eric Trump. A 24-month payback window on Bitcoin collateral versus the usual 6 months.
Yeah, that story definitely raises some eyebrows. It immediately introduces political and regulatory risk. Well, anytime you have a major Chinese company offering significantly better terms to a politically connected American entity, it triggers concerns about potential foreign influence, maybe unfair advantages.
Ah, I see.
It gives ammunition to political opponents and regulators who might want to paint the industry as tangled up in politics or susceptible to foreign interests. It could lead to investigations that are more about the politics than the actual technology or business. That kind of distraction is never helpful for the asset class.
So wrapping this all up for the listener,
Yep.
It's a real mix, isn't it? You've got this potential for serious short-term chop driven by geopolitics and maybe skittish institutions, butting right up against these incredibly strong long-term improvements, the quantum fix, the maturing derivatives market, corporate buying.
Right.
It really feels like you need a two-track mind right now.
Absolutely. You have to manage the immediate risk, the potential downside, but keep your eye on the long-term fundamental story that's still building. So 3 key things to watch in the near term. First, obviously, how does Bitcoin defend that $109,500 level? That's job 1.
It's critical support.
Critical. Second, the very next batch of settled ETF flow data. That'll be a kind of tiebreaker. Was the outflow a one-off blip or the start of something more sustained?
Yep.
And third, just keep an ear out for any change in tone, any de-escalation in that U.S.-China rhetoric. If that cools off, it could lift a major weight off all risk assets, including Bitcoin.
Right. Which brings us to our final thought for today. We saw that partnership between TokenWell and Crypto.com to offer index-based crypto investing, basically making diversified crypto baskets easy for retail folks to buy.
Yeah, and this mirrors what happened in stocks decades ago, right? Index funds made investing way more accessible and arguably lowered volatility compared to everyone just picking individual stocks.
Sure.
Crypto has been dominated by, high-stakes trading of individual tokens. This move towards passive index investing offers a much simpler, maybe lower-risk way for the average person to get exposure.
So the provocative question is, could this be the start of a fundamental shift towards passive investing in digital assets? Could that be the key to bringing in the next wave of mainstream users by making the whole thing less volatile and complex?
It's definitely something to think about. It's a trend that could quietly reshape the entire ecosystem over time.